Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy. So, welcome everybody. Hope you all had a great weekend, and it's almost the end of the summer, so it's Labor Day weekend coming up. Unbelievable. But let's get started. So we're going to go over some updates with the markets and some analyst information, and then we're going to talk about financial planning. We usually have a planning section. Today, it's going to be a broad topic. It's going to be objective advice, acting as a fiduciary, and a fine that was assessed to TIAA. So this happened in July, but it came up in a conversation with a client last week. So I thought it would be a good thing to talk about today. And Dolly, if you're listening, I appreciate you bringing that to my attention to talk about. So let's go over some updates from the slot group. So I like to read some of the questions and updates that we get throughout the week. And the first is, this is from Ian Berger. So Ian's one of the analysts as well in Ed's group. And well, first of all, I had some speaker issues this morning. I should check in with you folks and make sure that you can hear me okay. So first, let me find you. All right, so raise your hand for me if you can hear me all right. All right, wonderful. Thank you, everybody. All right, so Ian talked about participating in a 401k, and we talked last time we talked about how much last week. We talked about how much should I contribute. The question was, how much should I contribute to my 401k? And we went through traditional 401ks and Roth 401ks and explored really how to determine that. This week they talked about participating in a 401k and a solo 401k, and how if you work at a company and you have a 401k plan, and then you also have what they call a side gig or a side job, you can contribute quite a bit of money. So this can be really exciting because a lot of folks do. They have maybe some investment properties or something else that they do on an active basis, and perhaps they can start a solo 401k as well. So this only works, and I'm sorry, they talked about, let me just read it to you. In the August 16th, 2021 slot report, we showed that someone participating in a 401k plan through a regular job, so you've got your own 401k plan through the company you work for, can also establish a solo 401k plan through a side job, potentially contribute up to $58,000 this year in after-tax contribution to the solo plan. So of course you're going to have extra income as well, right? Or extra assets to be able to transfer into that. However, this only works if the company sponsoring the regular 401k plan and the entity sponsoring the solo 401k plan are considered unrelated under IRS rules. So that gets a little complicated. They have to be unrelated plans. So for instance, I have two companies. I have my property management company and my investment firm. Because I'm common owner, I can't have two different 401k plans and fund them up to the max for each. That would be there would be related companies. So the reason this strategy is so appealing is that that allows you to immediately convert those after-tax contributions to a Roth IRA through the mega backdoor Roth. We've heard a lot, and we've talked a lot about the backdoor Roth IRA contributions. This is referred to as the mega backdoor Roth. That way you could fund a Roth IRA with amounts far in excess of $6,000 or $7,000 if you're 50 or older on an annual Roth IRA contributions. Even better, the conversion would be virtually tax-free. Now you pay tax on the funds you receive first, but the distribution of the after-tax contributions are non-taxable. Although the earnings are taxable, you could defer taxation by rolling them over a traditional IRA. Bear in mind that a few conditions must be met for the mega backdoor Roth strategy to work. The solo 401k must allow for after-tax contributions. The plan must also allow for in-service distributions or after-tax contributions. And you would need to be able to afford to contribute the after-tax contributions. So all those things have to be allowed. It's really much easier today to establish your own 401k. They're still a little expensive, but not like it used to be. You have to pay attention to the costs. I just went through this with our company. We're switching plans right now because of the cost factor. So it's something you should review often. So if you're close with your employer, you should make sure that that employer is reviewing the costs, functions, availability of your retirement plan on a regular basis. I would say no less than every 5 years, but I look at them every couple of years. I look at ours, and it's, you don't want to switch around a lot because like there's always costs involved. I think we're certainly paying a fee to transfer from our existing 401k to the new one. So there of course has to be a benefit there, but investment choices, costs, options like, can I contribute to a Roth IRA? Can I do in-service distributions? Can I do in-plan conversions, things like that? So these are really important things to know with your 401k. Okay, so I'll just continue with this. Aaron, here's an example. So Aaron has a regular job with Global Industries that sponsors a 401k and recently established a solo 401k. So a solo 401k can only be for you and your spouse. You can't have any employees through a sole proprietorship. Global and Aaron's sole proprietorship are not considered related entities. So there's no common ownership or anything that would tie those two together. Aaron makes sure that her solo 401k offers after-tax contributions and permits in-service withdrawals of those contributions. Aaron's sole proprietorship is extremely profitable in 2021, allowing her to contribute $58,000. Now, it doesn't have to be the whole $58,000. It could be any portion of that in after-tax contributions to the solo plan. So she's not getting a deduction on that. She's earned the money. She's going to pay tax on the money that she's earned, and she's going to contribute to her solo 401k as an after-tax contribution. So it does not take tax deduction, is not considered a payroll deduction. She's paying tax on that money. Aaron wants to take advantage of the mega backdoor Roth. Sounds like it should be really loud. Mega backdoor Roth. So she takes a distribution of her after-tax account consisting of $58,000 of contributions and $2,000 in earnings. She converts the $58,000 tax-free to a Roth IRA and rolls over the $2,000 to a traditional IRA. That can work. Many regular non-solo 401k plans, especially those sponsored by small and medium-sized companies, do not offer after-tax contributions. So you got to be careful. That's because those contributions are subject to an IRS non-discrimination test. That rule prohibits after-tax contributions for higher paid employees unless lower paid employees make a certain level of contribution. So what he's saying here is that not a lot, you have to ask a lot, not a lot of plans offer these. I would say it's really hit or miss with after-tax contributions. Most larger plans will offer them, and they are getting better about Roth contributions for sure. Roth conversions are a little more difficult within 401k plans. So that's just a general idea. I'm not going to belabor that anymore, but that's a general, that's really a neat idea. If you've got a job and you've got an unrelated sole proprietorship or some other business that you're running, and you've got a solo 401k, and it's a way to put in a bunch more money if you can. But again, you've got to have the structure in place for it, and you have to have the cash to do it. All right. So the next one is about qualified charitable distribution. So remember, a qualified charitable distribution is when you're over 70 and a half years old. This follows required minimum distribution rules, but didn't get ratcheted up to the 72-year-old requirement for required minimum distribution. Qualified charitable distributions you can still make at age 70 and a half, but you've got to be 70 and a half. You can't do it before your 70 and a half birthday. So what is a qualified charitable distribution? It's an amount that you can take up to $100,000 at 100% of your required minimum distribution, and you distribute it directly to a charity. And so you don't pay tax on that. It's a way to empty an IRA without paying tax if you don't need those funds. If you have to first determine if you're going to need those funds. So here's the question that came in. I'm 72 years old and I have a Roth IRA. I have some extra cash in a bank account. Can I put that into my Roth? And how much can I contribute for 2020? Okay, I'm sorry, that's a different question. Let me do the QCD question first, and then I'll do the Roth contribution question. Here's the second question. Can you do a qualified charitable distribution to a donor advised fund? So again, qualified charitable distribution, I just told you what they were. And the question this person has is, can I send this to a donor advised fund? A donor advised fund is a type of charitable fund that you have some control over the investments and how it's paid out. The answer is, unfortunately, no. QCDs can only be made directly to a charity and not to donor advised funds nor private grant making foundations. So it's got to go directly to that qualified charity. All right, now the first question. Author writes, I am 72 years old and I have a Roth IRA. I have some extra cash in a bank account. Can I put that into my Roth IRA? And how much can I contribute for 2021? The answer, you could potentially contribute up to $7,000. Remember, he's over 50, or he or she is over 50, this writer is, to a Roth IRA this year, but there are a few strings attached. So first, you probably know this, you must have earned income. You have to have earned income for 2021. If you're making contribution for 2021, which you can't make them anymore for 2020, that is pay, because we're past the date here, we are August. That is pay from work or self-employed, not passive income, not Social Security, not things like that, but it's got to be pay from work or self-employment of at least as much as you want to contribute. So you have to make at least $7,000 to be able to contribute $7,000 in this case. If you don't have enough to earned income, but you're married, your spouse could make an Roth IRA contribution for you if the spouse has enough to earn income to cover both your Roth IRA and the spouses. So if this is a 72-year-old man and his wife is also 72 and she's still working and he's not, then they have more than $7,000, let's just say $14,000 in income, she could make a contribution for herself for $7,000. She could make a contribution for him for $7,000. And there is no age limit on this anymore either. Second, you can't make any Roth IRA contribution if your modified adjusted gross income, sometimes referred to as MAGI, exceeds a certain amount. For 2021, that limit for single individuals is $140,000, and for married couples filing jointly, it's $208,000. You can make a partial contribution if your modified adjusted gross income doesn't exceed $125,000 if single, or $198,000 if filing jointly. If your modified adjusted gross income exceeds those amounts, you cannot make a Roth contribution, but you may be able to make a non-deductible IRA, traditional IRA contribution, and convert it to a Roth IRA using the backdoor Roth IRA strategy, not to be confused with the mega backdoor Roth IRA strategy. So there's a lot there. You've got it. There are some caveats to be concerned about with the backdoor Roth IRA strategy. We've talked about those before. If you have questions about that, reach out to me. So good information. All right, here's one more for slot, and this is from Sarah Brenner. And she writes, the other day, an advisor called with an issue that comes up frequently, especially in these difficult times. His client made an IRA contribution for 2021 and was planning on deducting that contribution. However, his job situation changed and became an active, this is a good change. His job situation changed and he became an active participant in a retirement plan at a new job. While the new job and access to a retirement plan were good things, there was an unfortunate consequence. His IRA contribution could no longer be deducted for 2021. Why? Because he became an active participant in a plan and his income was too high for deductible IRA. Now, this is traditional IRA. Remember, you can have a 401k and a Roth IRA, but you can't contribute. You can't have a deductible traditional IRA and a plan. Here are some strategies to consider if you find yourself in this situation. You could withdraw that contribution first. If the contribution was not deductible, you may decide that you do not want to make an IRA contribution at all. Maybe that's the whole reason you did it, was for the deduction. That's your choice, and there's nothing wrong with that. You will need to remove the contribution and the net income attributable to that by October 15th of 2022. So you have until October 15th of the year following the year you make that contribution to recharacterize it or take it out. There will be no excess contribution penalty, and the contribution will not be taxable. Only the net income attributable will be taxable and potentially subject to the 10% early distribution penalty. You can recharacterize that contribution. If you're eligible, you may want to consider recharacterizing your non-deductible IRA contribution to a Roth IRA. There are income limitations, as I just talked about in the previous question, for making Roth IRA contributions. So it may not be available for everyone. However, this could be a good strategy. Recharacterization is not a taxable transaction. Funds will be directly transferred to your Roth IRA. The deadline, as I said before, is October 15th of the year following the year you make that contribution. So in this case, that's 2022. You can keep the non-deductible contribution. Maybe you want to keep the funds in the IRA, even if you cannot deduct the contribution. So you can keep it in the IRA. You just won't be able to make that take that tax deduction on that $7,000. You'll need to file IRS Form 8606 with your 2021 federal income tax return to claim the non-deductible contribution. In the future, when you take distributions from your traditional IRA, these funds will be returned to you tax-free, not the earnings, but the $7,000. The trick is you got to pay attention to it and you got to count those. Don't forget about it, or it will be taxable to you. And that happens a lot. So you end up paying tax both of those. Or you can do that famous backdoor Roth conversion. This really should be a contribution. Here's a creative solution that may work for you if you are interested in Roth IRA, but your income is too high. You can make a non-deductible IRA contribution and then convert it to a Roth IRA. This is called a backdoor Roth contribution. Unlike tax year Roth contributions, there are no income limitations because you do it as a conversion. So good update from Sarah. Any questions on that before I move on to investments? Okay, I see no hands raised. All right, we're going to talk about in some of our analyst reports today, we're going to talk about tapering. So we're hearing that a lot on the news if you're listening to the news, and I thought it would be good to talk about what is tapering. So I did some research, and I like to, as you know, I like to find things that you can access yourself. I typically find myself liking what's on Investopedia. However, in this, with this example, the best article I could find for tapering was from Brookings. So if you just Google what is Fed tapering, you'll find a lot of different things. And this was from brookings.edu, and it's a blog, but it's a good long article with a lot of charts and graphs that I found really interesting, but it sums up really well in the first couple paragraphs of just what is tapering. This is worth the read if you have an interest, and if you want a link to it, I'll drop it in the YouTube link for sure when the video is done. But if you want it before that, because that'll take about a week probably before that's up online, you can email me and I'll send you the link. So this is the description of tapering, and they're going to talk about quantitative easing in here too. So in response to the economic impact of the COVID-19 pandemic, the Federal Reserve cut short-term rates to zero back in March of 2020 and restarted its large-scale asset purchases, more commonly known as quantitative easing, or QCQE. Since July 2021, the Fed has been buying $80 billion of Treasury securities and $40 billion of agency mortgage-backed securities each month. $80 billion of Treasury securities and $40 billion of mortgage-backed securities each month. As the economy rebounded in mid-2020, federal officials began talking about slowing or tapering the pace of its bond purchases. So this quantitative easing is a massive purchase. So the government issues the bonds and then the government buys the bonds. So you hear about the government balance sheet growing because we keep owning these bonds. We're issuing them and buying. So tapering is simply the slowing of that. So why would the Fed start tapering? Well, the idea is that employment is down, unemployment is down. So we're at about 5.49 or 5.4% unemployment. And the idea is the economy is hopefully beginning to rebound a bit. And you want that to rebound on its own. So they say, we're going to just pull off the gas a little bit and kind of see where things are going, because they can always jump back into it. So as the economy rebounded in mid-2021, Fed officials began to talk about slowing or tapering the pace of its bond purchases. And then the next bit I thought was good too. Quantitative, why does the Fed buy long-term debt security? So why does it buy its own bonds? And this, using this tool, we call it quantitative easing. Quantitative easing helps the economy by reducing long-term interest rates. It's a way to control the interest rates by buying your own product from the federal government, because the Fed can set the Fed funds rate, which is the amount that the Fed lends to the banks, and hopefully the banks, then have a bit that they charge above that, sometimes more than less, or more or less. But the market also controls interest rates. So here the Fed is really trying to control the market as well. Quantitative easing helps the economy by reducing long-term interest rates, making businesses and mortgage borrowing cheaper, and by signaling the Fed's intention to keep using monetary policy to support the economy. Again, one of the big reasons we had such a good turnaround in the drop that we saw from the pandemic last year in 2020 is because we had a full backstop. The government said and signaled and did whatever it needed to do to make sure that the economy didn't collapse and that the market continued and rebounded really nicely. They just kept throwing trillions of dollars at it. So quantitative easing, and by signaling the Fed's intention to keep using monetary policy to support the economy. The Fed turns to quantitative easing when short-term interest rates fall nearly to zero and the economy still needs help. So if they say they're going to cut interest rates to zero, if that doesn't stimulate the economy, then they said, okay, we're going to buy our bonds. It not only helps to manage interest rates, it also helps flow of cash into the economy. Okay, so that is tapering and quantitative easing. Now, why does that matter? There's a lot of conversation with analysts about this tapering. And the first is BlackRock, and I thought this was really interesting. So they have a snapshot to say, BlackRock has portfolio managers all over the world, and they do a summation of what their portfolio manager views are. Now, this is not a recommendation to use BlackRock funds. I have some BlackRock funds in our portfolios, but for instance, I was just looking at introducing another fund that I used years ago, and then they started falling out, a BlackRock fund. I'm not going to say which one. And I looked at reintroducing it, and it is not doing well compared to others. And mutual funds you've heard me say this before, and I would think that it's still about 92%, but it might even be higher, but about 92% of the mutual fund managers, so professional money managers who get paid an awful lot of money to manage clients' money, don't beat the index that we compare them to. So we've got a really, really small stable of funds, active management to choose from. And that's why you see these exchange traded funds really doing so well, because they're not actively managed for the most part, and they're much, much cheaper to pay than paying somebody to underperform. Now, no problem with paying someone to outperform, but we don't want to pay for mediocrity or for them to stink. So what's BlackRock portfolio manager saying about, so these are the folks that manage those portfolios that hopefully outperform and make money for their clients. What did I say about this issue? So the market debate around the Federal Reserve's tapering of asset purchases, they write, is heating up. The BlackRock portfolio managers last week discussed the impact on economic growth in the short run. The result, the majority of the managers, 67% of BlackRock portfolio managers, think tapering won't have an impact, with most saying the economy is ready to function without the support. So they're saying if the Fed pulls off the gas, the economy is going to continue to go. How about the impact on the market? The BlackRock's investment institutes view is that the more important change in the monetary landscape, the Fed's liftoff from zero rates is still a long way off. So they don't anticipate, while they may ease off of the buying of the funds, the bonds, they don't anticipate them moving much off of the zero level of interest rates until maybe 2023, I believe they said. The Fed's liftoff from zero rates is still a long way off, and then we are unlikely to see repeat of the 2013's taper tantrum. Well, taper tantrum is when they're kind of on and on again and off again, and it seems a little erratic. BlackRock portfolio managers do worry about the long-term impact of the unprecedented fiscal and monetary stimulus, including the proposed infrastructure package and spending plan. More than a quarter are anticipating that this unprecedented injection of liquidity, driven in part by central bank asset purchases, will inevitably lead to an overheating and excessive inflation. What did that just say? So the majority of the portfolio managers for BlackRock are very concerned about all this money that has been injected into the economy and is potentially going to be injected into the economy with this huge infrastructure deal, and have a significant effect on inflation. Again, inflation. BlackRock has been warning against higher inflation for over a year now, and we're certainly seeing it. As I've said before, the question is, when we look at year-over-year inflation this year compared to last year was, gas was $1.85 a gallon. Now it's 3 something. Probably we'll get to $4 a gallon. Are we just comparing year over year? Super low inflation, now super high inflation. The concern is what's going to happen as we go forward and we get some balance. I think that inflation is going to continue to be a problem, but that's just my opinion. This says here, for the past year, BlackRock's been warning about underappreciated medium-term inflation risk and fragile equilibrium of low interest rates amid surging debt. And I 100% agree with them. So we've got a lot of debt, low interest rates, and this really high potential inflation, and we could see some significant drops and a faltering economy, I believe. But I'm hopeful. I'm hopeful that that's not the case. And we really do have to maintain that optimism. So remember, we want to be defensively optimistic in our investments and build that structure so we can take some of the shakes of the markets, but that it won't collapse everything. And not surprisingly, Riverfront, moving on, they believe it's now time for active management to shine. So what is active management? Active management is when you have an active portfolio manager like BlackRock, like Riverfront, who are making decisions about what they're going to buy, sell, or hold in their portfolios. And therefore, they charge a bit more than a passive management, which is an index fund or an ETF, exchange traded fund. Sometimes a lot more, as much as 1% more or 2, or some alternative investments are 3-4%. So you really got to earn your keep. So as an active portfolio manager, Riverfront, we believe now is the time for active management to shine. So they are saying that the way we do business is going to be the way to go. The bond yields, especially in the bond markets. Now I can agree with this, because bond markets, I've been using active management bond markets, so mutual funds or individual investment managers for some time, because they potentially would do a better job of managing the risk of bonds falling as interest rates go up at some point. 3 market factors that point to the need for active management in Riverfront's views are bond yields and credit spreads remain near historically low. External pressures on America's largest companies is growing, and some emerging markets are becoming less shareholder friendly. So a strong theory is the S&P, the big markets, the S&P 500, even to some point, large global interests as well. Some medium-sized companies, they do better with passive management. You really can't get much value there. So that's been a long-standing belief among many folks like myself. But where you can get value from active management, individual money managers or mutual funds is in the smaller companies or with what we call fixed incomes, bonds. But what Riverfront is saying is that even the larger companies now, they believe they're going to benefit from active management because of some of the pressures on the largest companies in America and emerging markets being less shareholder friendly. So that's yet to be seen. It's going to be interesting. Again, I don't use Riverfront at all. They're not in our portfolios at all as far as a management company, but I think their research is very, very good. It doesn't mean Riverfront will never be. We're always looking to at opportunities for our investment structures or portfolios. So it may be. They have an interesting covered call strategy that we're looking at right now, but I don't know if it's going to make the grade or not. All right, so where are we with the markets? Week ending last week, so that was what, the 27th. Year to date, the S&P 500 was up 21.19%. The Dow Jones Industrial Average was at 17.26, and for the week, just 1 week, return of the S&P 500 was 1.54 last week, and the Dow Jones Industrial Average was down 0.98. Now, yesterday I was just checking my phone as I had the day off, but I saw the market was down yesterday. It's down a bit today. We're still very high year over year. So this time last year to this time this year, the S&P 500 is up 31.96%. Excuse me. Dow Jones Industrial Average is up 26.85. So still really great growth. These year-to-date numbers are fabulous. As I've said, if we end the year at 17% for the Dow Jones and 21% right where we are today for the S&P 500, I would be extremely happy, as I think all of you would be too. All right, moving on to our financial planning portion. I want to talk about objective advice and a fiduciary requirement. So you may have seen this, but in July, the SEC announced a $97 million, they call it an enforcement action, but it's a fine, against TIAA. So a subsidiary of TIAA ran afoul of the SEC, and there are some significant portions in here. Now, why am I bringing this up? There was a New York Times expose several years ago. I was still at Wells Fargo, talking about the conflict of interest of TIAA. So that goes back at least 10 years. So 10 years later, the SEC gets around to say, oh, it's true. Our findings are that TIAA is steering people to more expensive investment platforms that are benefiting the profits of the company. Now, there's nothing wrong with the company being profitable. The problem is that when you say that you're giving objective, low cost advice, you can't push people to one of your own platforms or products. In my opinion, TIAA is one of the worst offenders out there, and they also have a tremendous amount of money. What wasn't touched on in this is that they jail lock, in many cases, people's money. I've got example after example after example in my career where I've seen folks have substantial amounts of money with TIAA, and they can only take 10% a year out, even while they're retired, even when they're over 59 and a half or 70 years old or whatever their age, they can only take 10% a year. And it's not that they can't pay an early withdrawal penalty or anything like that. They just can't get their money. And that is so unfortunate. And I still can't believe that the SEC hasn't done something about that. But what they did about this, and you can find it right on the SEC website, if you just Google TIAA fine, they referred to TC Services, which was a subsidiary of TIAA, but that doesn't matter. It's all TIAA. Trained its wealth management advisors to make representation that they offered objective and non-commissioned advice that put the client first and acted in the client's best interest while holding themselves out as fiduciaries. This was misleading because TC Services' financial incentives for their wealth management advisors rendered their advice non-objective and TC Services did not ensure that the wealth management advisor's recommendations were, in fact, in the best interest of clients. So what they're saying is that they were compensating these folks to have money put in a TIAA-CREF model that had more fees than other things that were available, all while saying they were giving objective, non-commissioned advice. And we know whether it's TIAA, whether it's Wells Fargo, whether it's Merrill Lynch, they all have these conflicting issues going on. You know, when I really enjoyed working with Wachovia, when Wells Fargo came over, it was all about Wells Fargo product, mutual funds, insurance. It was all very incestuous. I obviously have a passion about this because things like this drive me crazy, and it's wrong for the clients. So I'm glad to see some enforcement action to a big number here. $97 million is not a small fine. The SEC continues to write, investment advisors must clearly and accurately disclose their conflicts of interest here. TC Services, which is part of TIAA-CREF, disclosures, and here their disclosures and misleading statements downplayed and obscured financial incentives that created conflicts between its wealth management advisors on one hand and its conflicts on the other. And the SEC order finds that that TC Services willfully violated several sections of the code they list. Now in Reuters, Reuters reported on this, and there are a couple of interesting comments in Reuters. They went on to say some advisors made misleading representations that they put the client first and were trained to identify clients' pain points before recommending portfolio advisor. That's the structure there that where TIAA made more money than other things available. So they were trained to identify clients' pain points before recommending portfolio advisor as a solution to their fears about investing, regulators said. That's really troublesome. TIAA relied on its reputation as a trusted and objective financial advisor to profit off of clients through fraudulent and manipulative sales practices, they said. We're finally making things right. Wow, big statements. So, and that's another thing, when you have this agency, TIAA, always coming out off as, you know, this benevolent organization that only supports not-for-profits, teaching organizations, and they're taking advantage of these folks. So good for the SEC to find it. You took way too long, SEC, but $97 million is no small impact, I hope. So how do you handle this? How do you know what to do? How do you know if your advisor is a fiduciary, acting in a fiduciary capacity, doing what's best for you? Well, first of all, you've got to check, you've got to ask. So I had a client, prospective client, come to me one time after a class, and she told me how she was working with this advisor who was an advisor with, I think it was Ameriprise. And she went on to tell me that he only charged her $500 a year. And you know, she had over $1 million in her investment accounts. And she said, and he's so thoughtful about it, he even asked me when he's going to charge me. And I said, boy, that doesn't sound right. I mean, that's an awfully low fee that you're paying for investment advice and financial planning. You know, he does a financial plan for every year. So but she did say, I've asked him if he's a fiduciary, and I really don't understand his answer. You know, I said, what was how did he answer? And she says, I'm not sure. You know, he said, well, and I said, well, that means no. That just means no. If you can't answer yes, then that means no. So and we went through the statements together, and it turned out that she was paying quite a bit more in fees. I think to the tune of about $15,000 a year in fees instead of $500 a year, which she was not happy about. But that was the truth. So you've got to ask, and you've got to check, and you've got to also look at credentials. So if you go, I'm going to share with you on my website. Okay, here's our homepage. I went into services. I went into financial planning. And I did this on purpose, right? CFP, certified financial planners, were required to act as fiduciaries, always do what's in the best interest of our clients. And in fact, there's a code of ethics that we must follow. So number 2 on here, well, first is act with honesty, integrity, competence, and diligence. Number 2 is act in the client's best interest. You know, exercise due care, avoid or disclose and manage conflicts of interest. maintain the confidentiality and protect the privacy of client information, act in a manner that reflects positively on the financial planning profession and the CFP certification. So that's all well and good. It's important that you see this, right? Act in client's best interest. Of course, this is very important too. This should be just what everybody should experience. Unfortunately, many in the industry continue to fight this. If you do the research about the fiduciary rule, one of the biggest offenders of fighting against the fiduciary rule was Merrill Lynch. I think they're starting to come around, or maybe they've come around, but this is very important. So you'll also see after my name and accreditation, accredited investment fiduciary. That simply means that I've had additional training, specialized training in helping people manage their fiduciary responsibilities, or examining firms, or helping firms determine if they're in fiduciary compliance. And that's really about fiduciary compliance. So I take this seriously. I think it's very, very important. More people are talking about fiduciary responsibility today than they ever have, and that's a good thing. 10 years ago, when I first received my, maybe 11 years ago, my accredited investment fiduciary certification, few people were talking about what is a fiduciary and how does it affect me. So that's important. Companies like TIA, CREF, they've got conflict just like anybody else. It is how you, and we do too, by the way. And if you're a client of ours, you've heard me talk about it, with life insurance policies, some annuities, we can't include them in our annual fee. So we receive compensation directly from from the insurance companies. And that's important for you to know. And you should ask about the, income structures or the payment structures, and I disclose those things, and that's important. It's not that you won't have conflict, you have to disclose it. Walter says you can use broker check on finra.org. You can do that. You can do that for sure. You can look up the SEC. Broker check. What broker check is if there's been any disclosures or events for an advisor or financial planner, that'll help as well. That's a good point, Walter. Thank you. All right, folks, it's 10:45. We're at the end of our time today. I'd like to wrap up by 10:45. I hope you have a great day. I hope you have a great week. And I hope to see you tomorrow night, 6:30 here. I know you've all gotten email invitations. You'll get 3 more. So you'll get one at 11 o'clock today. You'll get one at 6:30 tonight, and one an hour before the webinar tomorrow. And I'm sorry if you've already registered and you're still getting these nuisance emails. I don't know how to turn that off once you register. That's something maybe I'll figure out in the future. But I hope you enjoyed this, and I hope you have a great day. Take care. We'll see you next week.
Hello again. I hope you enjoyed the video, and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.